You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Really excited today to have a great guest, Jake Clopton, on the show. Jake is a commercial debt and equity broker. He also has multiple apartment communities he owns and operates across the Chicagoland area. Founded Clopton Capital in 2009 as a way for property owners and operators to efficiently access both debt and JV equity for commercial property deals. And he focuses on the small to middle market space on those asset classes. And since its inception, Jake has arranged billions of dollars in financing for borrowers nationwide. He also owns Clopton Insurance Services, a national insurance agency. And there's been a lot of news about insurance over the last year or two, a lot of challenges for a number of investors I know. So Jake, thank you for joining the show.
Hey, you having me on. Thanks, Jack.
Absolutely. So always like to start with understanding someone's path. So just tell us a little bit tell us your story. Tell us how you got into real estate.
Yeah. Probably not the normal story of most people that get into real estate. Back in like the early 2000s, 2006 era, right? I was trading interest rate futures, 3-month LIBOR. I did that for several years until the crash. And at that time, trading was really difficult. That market just evaporated overnight, right? And I really needed to find like something else to do. Generally, that was really kind of the genesis of switching career. And at the time, it was a credit crisis, right? So it was just impossible for people to find anybody that was lending money. So my idea was to create a business around finding people capital. It wasn't just focused on commercial real estate at the time. It was just any sort of lending to businesses at all. Really, I just started the entire thing on doing cold calls. I would just cold call anybody, seeing if they were lending, at all. And if I could find somebody, I would just put it out there and people would show up looking for loans. And that was about 16 years ago. And that's how it started.
That's great. It's always, very few people, I think, set out in life and say, oh, I'm just going to, be a real estate, unless your parents were brokers or something, and it's more specifically being on the commercial side as opposed to the residential side. Is there something that drew you to the commercial side of the business more than residential? Yes, residential crashed in 2008 too.
Yeah, residential definitely crashed. I was really focused on business lending, and at first, really, it was any sort of business. I remember even doing semi trucks back in the day, right? But just really gravitated towards commercial real estate. I think I liked the people that were involved in it, and it was just it was interesting and really kind of just where the market. Commercial real estate was also just really, I think, the big opportunity at the time, right? I think the biggest difference, even at the time between commercial and residential is that when the floor dropped out of residential, there was no floor, right? You couldn't sell a house for any price. Commercial real estate is different, right? Because there's always a buyer at a certain level. So it didn't get quite as bad as residential does. And, it kind of carries through to today when a lot of people are like, oh, there's going to be this huge commercial real estate crisis and blah, blah. I'm like, well, maybe, but not really like residential was, right? Because there's always a buyer at some level of commercial. That's the biggest difference.
Yeah, absolutely. And, I talk to a lot of people who are talking about, they're waiting for the residential crash. And I'd be curious in your opinion on this, but I don't see a residential crash happening this time around. I think there's too much fixed rate debt for 30 years.
I think, people are, I think if somebody's saying there's going to be like a huge real estate crash, they don't really understand what happened back in 2007, 2008, right? That was a huge banking failure just all around and a huge lead up to it. Don't get me wrong, there's certainly problems, in the debt market, but when you look at what's actually going on in the economy, like the underlying economics of, for instance, just residential alone, incredibly strong. I just don't see a crash. I mean, even with the run up in rates, recently, we're still seeing house prices go up. And it's really because of, the lack of supply in the housing market all the way around in homes for sale and on the rental side. So I just don't see it, man. I mean, there's too much support in the economy. And, when you really take a step back and maybe not listen to so much of, all the people that are, kind of spitting all the fear out there, look at where the labor market is, look at GDP growth, look at the demographics of housing. I mean, it's just strong all the way around. And I understand the cost of capital has gone up and something will happen there, but I just don't see a crash happening. I mean, it's just not set up for it. Maybe I'm wrong, but I just don't see it right now.
Yeah, no, I absolutely agree. You hit the key points. Lack of supply for sure. I read a stat that roughly 40% of homeowners don't have a mortgage, and another 30% locked below 4% interest rate.
Don't have a mortgage. Oh, interesting. Okay.
Yeah, just the baby boomers and just people. I think you underestimate how many people have free and clear property.
I mean, I'll flex on my mortgage rate. I have a 2.5% rate, so.
Yeah.
I would move if somebody paid me, right? I mean,
same as me. I closed in January of 2021 on a condo in Puerto Rico, 2.8%, and I'll never, I would say never say never, but there's a point maybe I would just sell and trade up.
Right now. Yeah, exactly.
Yeah, exactly. It just doesn't make sense to sell. So with that said, I mean, I've seen, so for those that have been waiting for the residential crash, I don't see it happening, but there are real pockets of distress in commercial, and
that's for sure.
I'd love for you to talk through, as someone who's been in the market the entire time. I think more specifically from roughly 2020 through last year, there's been major shifts in interest rates, and there's been pockets of buyers that bought primarily multifamily apartment buildings, but there's a pocket of buyers who bought loans that had variable rates, and that's where I've seen a lot of the trouble. Can you maybe just talk through what you've seen over the last 5 years on specifically the variable rate deals and what's happened with SOFR, and how you've seen things progress from interest rates and cap rates for the deals you've seen done over the last 5 years?
Yeah, I mean, look, we all know what happened in 2020, right? I mean, rates went to zero and stayed there for a very long time. And at the same time, you had, money supply expansion. Actually, if you go to the Reserve website and look at M2 money supply expansion, I think in a 3 or 4 month period, you had the same amount of, money growth as you did from I think it was something like 7 or 8 years during the teens of the 2000s. So it was really incredible, the growth in money supply. I think, really what caused a lot of, the people getting stuck in these variable rate loans was you had entrance into the real estate market that had never been around during a rising rate environment. For some reason, people just, I think really it was just complacency, and then, maybe some naivety. They just had never experienced that. A lot of people just got stuck. And I tell people this all the time too, because people say, oh, well, multifamily's in trouble because look at all these variable rate. Well, that's not really true. There's deals that are in trouble, right? There's you got to bifurcate the thought process between the asset itself and then how it was capitalized, right? The apartment building is fine. And all the variable rate deals I see, I'm working on several now, they're 100% occupied. It was really the structure of the capitalization, the debt that people took on, and not being able to, to appropriately protect themselves on the rate side, because they just never thought rates were going to go up. And when you lever a deal at 85% of cost, it's priced to perfection, and you have to have all of your assumptions work out just to get out of it. And then at the same time, the cost of capital quadruples or whatever it was. I mean, of course you're going to get stuck, but that's not really the property's fault, right? The economics of the property are still great. It's really just the, investment structure that people put together that was the problem. But that's what I see constantly over time. And I do see a lot of those deals today, and they, we've seen some equity, investments disappear, but they just need to get recapitalized. And those deals I'm seeing being recycled into the market. And the vast majority of the time, I'm not seeing distressed sales. I'm seeing recaps. Right? People just raising more equity around the deal, getting in a different basis. or just the investors, if they own it on themselves, just paying it down, because these are still good investments. It was just, the financing they took on that was the problem.
Yeah, there's a great point. So that's where I've seen, and look, we're in a lot of deals, and we've had a few that have been pretty challenging. We've had a few where we had to make capital calls, and the ones that seem to be navigating things the best are the operators that have the liquidity to either pay it down themselves or the base of investors and the track record to raise that additional money. And the ones that tend to fail are the ones that, were groups of people who went to a course, kind of clubbed up together and had a lot of small checks where there's not that critical mass to raise enough capital to salvage a deal.
Those are the guys. And when you think about it, that's the structure that sees the most challenge, right? Because think about the guy, the general partner, right? That's running the deal. He didn't have the money in the first place. That's why he syndicated it, right? And you need somebody to step up to the plate to come in, and pay this note down. But the only way to do that is to go back out to your investors and raise additional capital, or go to a third party investor and raise additional. I mean, somebody somewhere is taking a haircut somewhere in that structure. And that's the challenge that I'm seeing, getting out of these situations is it's like, all right, who's taking the haircut? Is it the GP? Is it the other LPs? And that's why I've seen a lot of these deals just kind of get, pushed out and kind of sit around as almost zombie deals because, they're not really getting an agreement on who's going to end up taking the haircut on those.
Yeah, that's what we've seen. And frankly, anyone who doesn't have to sell is generally not selling this year. We're in deals with, 7 and 10 year fixed rate debt from 2020 and 2021 that no reason to sell right now. You've got really cheap debt. Rents have went up significantly, and overall costs have went up a bit as well. But in plenty of markets, rents went up 20-30%. We'll talk about insurance in a bit because I know that's a big component of expenses. What have you seen on? Obviously, SOFR went from 0 to 5. The 5 and the 10 year have moved moved up a lot, but have really come down in recent the last month or two. Where have you seen kind of the prevailing cap rates move from, I guess, similarly from the 2020 times to kind of current market conditions?
Yeah, I mean, it's a good question, right? And it's kind of hard to say. And a lot of it, again, depends on the nature of the deals, right? But generally speaking, let's talk about multifamily, right? Cap rates for multifamily on average trade at around 215 basis points over where the 10 year is, generally speaking. But I think, the problem when you're in an environment like today is you get expectations of where they're going. And exactly like you said, like people aren't, if they don't have to, they aren't selling because, we're effectively at peak rates right now. And I think, anybody can make an educated guess that the cost of capital is going to be much lower in a year's time. And if you sell today, you're selling into that more expensive cost of capital. And, listen, at the end of the day, commercial real estate is just math. Somebody either has to come in with a lot more equity or they have to sell it at a lower price, right, to make it work. So I am seeing things trade today, like especially multifamily for, cap rates that don't necessarily fit that 215 over the 10-year kind of average. But also the 10 years incredibly volatile, so it's hard to tell what the average actually is. On some other properties, like, we look at all asset classes. I definitely have seen, more volatile cap rates and more cap rate, expansion in like special use asset classes like hotels and stuff like that. But I think, it probably speaks to some of just the strength of the asset class in multifamily. Again, for instance, that, I've seen cap rates hold up very well. Like a lot of them, I've seen some 5s out there, 6s, nothing nothing pushing up into like the 7-8%, maybe in like real distressed markets, right? But I'm talking about on average. So seeing, still very, very aggressive, strong cap rates in multifamily and really not an enormous amount of volatility. But in other asset classes, absolutely. Industrial holds up incredibly well. I've definitely seen some cap rate expansion in retail, but these special use asset classes, I've seen cap rates really bump up.
Yeah, industrial is one of our favorite asset classes as well. Especially that small bay, maybe a room for an office, some storage, a couple garage bays for those HVAC contractors, electricians, the companies that seem to have more jobs than bandwidth.
Exactly. And like, in industrial, the same thing as multifamily, right? Part of the way to analyze an investment is, cap rate. But those cap rates, I think, are still staying very compressed because of the expectation of rent growth in those asset classes, right? So, there's a couple different ways to grow your bottom line, but I think it speaks to, the perception of, future rent growth in multifamily industrial for why those cap rates are still staying very low.
Yeah, that's been a big mystery for me is when we're trying to figure out our exits on some of these deals. When there's a big value add component, the cap rates will trade significantly tighter. If you could raise rents by $300 a month on a renovated apartment versus an unrenovated. And what we've seen with all the pressure on interest rates and expenses, some of the operators just haven't renovated as many units. They're focused on keeping occupancy high because they can't afford not to, just because, a couple of years ago, you might have taken occupancy to 70%, renovated as many units as possible. But now, you can't take occupancy down that low and lose the extra rent, the rent coming in because your interest costs have tripled, even with interest rate caps. The other thing we've seen is there's certain markets that have a lot of supply, and there hasn't been enough supply since 2008, but markets like Dallas and Phoenix, there's a ton of new Class A apartments coming online right now, and it is trickling down a bit more than I thought. If you're in most of the stuff we own is like the rents go from 12 to 1,500, and the new construction they're putting new apartments on the market at 2,200, but it's putting a little pressure on the market as the best tenants from the prior $2,000 apartments are getting 2 months free or 1 month free and going into the 2,200. And I think the best tenants that would have paid 1,500 are now paying 1,700 because the next unit down, the former Class A, is now moving to a B plus. So we've seen some pressure on occupancy in these key markets, but I don't know if you've seen the same thing, but permits now have plummeted. Anything that wasn't already going vertical by 2021, 2022, the permits have dropped 60, 70%. So I think we're back at another cycle with less new construction that should be coming on in 2025, 2026, and for maybe a few years after that. That's a good
point, right? And, this kind of goes back to one of these things where it's like, the Federal Reserve is trying to contain inflation. And rent growth and housing costs increases were part of that. But, they're kind of causing a problem in and of itself because you skyrocket the cost of capital. Again, real estate is just math, right? And what I've seen the past, year and a half since, the run up in rates is a huge drop in starts and, new apartment, new housing, new homes going up. And when you already have so there's some markets that, like in some sectors of housing that did get overbuilt, right? Sunbelt Class A stuff. Sure. Yeah. But that's not the entire market, right? And when you have, almost 2 years of almost just stagnant growth because nobody can build anything because the math just isn't mathing, you can see how, probably in the next year and a half, you're going to get even more supply constrained because the population is not going down, certainly not. But you're going to have just an entire period of where there was no increase in units. So I can imagine over the next couple of years, we get next year or two, we get pretty substantial rent growth because, there's really going to be a lack of supply because of, just the lull in construction starts. And that's going to push, rents up higher and, it kind of works against what they were trying to do in the first place. But
yeah. To me, it seems like the Fed is basically folding on inflation. There are certain, I guess it's not quite at 2%. It's at 2-point-something%, but it's almost like guaranteed there's a rate cut in a few weeks unless something major changes.
100%. It's the dual mandate, right? It's stabilize inflation and then maintain full employment. And I think we've gotten to a point where the downside risk in employment is starting to outweigh the cost benefit analysis of keeping rates higher to keep inflation lower. Inflation's definitely coming down. It's not what it was before, but I can't say it's disappeared.
Yeah, well, it never disappears, but yeah, did we get over that COVID bubble of inflation? The challenging thing, at least, and I listened to a lot of Peter Zeihan, who this economist that discovered, and he's more of a geopoliticist, but the fact is, all the baby boomers are reaching retirement age. The average baby boomer is 65 or older. And then add to that with, COVID, a lot of them retired early. And there's a labor shortage. There's a systemic labor shortage for those, kind of middle class, kind of upper middle class jobs. Like there's an absolute shortage for that. And that's systemic, and that's going to cause inflation. A supply chain reshoring, not relying as much on cheap goods in China. I mean, there's just a lot of just systematic pressures on inflation that weren't there 5 years ago as well. So I question if it ever really gets under control.
Yeah, that's for sure. I mean, I think we did cure a little bit of the dislocation in the labor market, right? Like, job openings versus people looking for jobs isn't quite as bad as it was before. I mean, before I think it was like 2 job openings for every person that was even looking. I don't know how real all those jobs are. I don't know, right? But I think that's also what was really causing some of the work from home stuff, because you had, just to get somebody to work for you, you had to agree to let them work from home. So we'll see how well that works out when, we get a recession. I think suddenly there'll be a lot of people in the office just to, have jobs. But I don't know. It's definitely going to be interesting the next year or so and see what happens here and if we're actually going to get it down.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.